Good afternoon. My name is Zachary Brook, and today we are going to explore sensitivity analysis for capital budgeting. Objectives for today's presentation. We are going to explore what financial management is and how it relates to capital budgeting. We'll examine the financial methods used in determining a project's risk and as it relates to capital budgeting. And finally, we will examine what, why, and how to conduct sensitivity analysis. Financial management's overarching goal is to maximize owner or shareholder wealth. This is accomplished through the supporting goals of profit maximization or making more revenue than costs, liquidity management, ensuring a supply of cash for short-term obligations, risk management, protecting against operational and financial risks, ensuring growth and sustainability or investing in long-term growth projects, and ensure the efficient resource allocation. And this is moving capital around that support growth in the long term. The functions of financial management include making investment decisions or capital budgeting. This is accomplished through decisions on what projects or assets align long-term returns and the company goals and strategy. Also, making financing and dividend decisions by choosing the right capital structure and deciding between reinvesting profits and rewarding investors. Management of working capital by managing the short-term assets and liabilities. And finally, we have risk management, or the identification and mitigation of financial risks using tools like sensitivity analysis. Capital budgeting in basic terms is money planning. That involves generally long-term projects involving large initial investments whose returns could be spread over multiple years. This is affecting the company for years to come. Investments like these generally carry some level of risk and uncertainty concerning future cash flows. Common methods of project evaluation are net present value, NPV. This calculates current value of future cash flows minus the initial investment. Internal rate of return, IRR. This is a discount rate that makes NPV equal 0. Payback period, time it takes to gain initial investment, and the profitability index. And this is the present value of cash flows and initial investment. As before mentioned, capital budgeting is a use plan for the money generated by a firm. The money generated can be reinvested into projects that will hopefully generate more money and create growth. Upfront costs are usually at risk when a new project is up for evaluation, so a company will utilize external and internal risk assessment methods to determine and mitigate these risks. External firm risks are risks that could affect a project that the company may have no control over, and these reside generally outside of that firm. Methods for determining those risks are market and industry risk analysis, which includes looking at market size, growth potential, and what the competition is doing. Other factors to analyze would be inflation, interest rates, which could affect the future value of the project. Country and political risk analysis for international projects would include determining what effect political unrest could have on the bottom line for the project, as well as exchange controls and international regulatory bodies. Regulation and legal risk analysis would need to look at the cost of change in regulations relevant to the project and permitting requirements to forecast potential delays. Internal methods of risk determination are more numerical in nature. For example, risk-adjusted discount rates factor in discount rates for NPV calculations. Higher risks are often given higher discount rates seen in the required rate of return. The problem with this method is that it applies a single number to risk, which can oversimplify the risk, and there could be subjectivity based on judgment from management and not numerical data. A Monte Carlo simulation utilizing random sampling and probability to simulate a multitude of scenarios. This method has interpretation challenges and can increase a the false sense of accuracy with its results due to the sensitivity of input assumptions. Scenario analysis examines multiple variables in reference to an event or situation. A downside to this method is that there is no probability of an occurrence of that situation and the lack of correlation between the variables. Finally, we have the sensitivity analysis, and this adjusts one variable at a time to determine a project's vulnerabilities and plan for potential responses, which we will be examining in further detail today. One tool for forecasting a project's feasibility is a sensitivity analysis. This is commonly referred to as the what-if analysis. This relies on a project evaluation to be done first, then the question is asked, what if? Then one variable is changed to determine the sensitivity of the project to a set of variables in order to determine risk of profitability. This differs from a scenario analysis where instead of one variable that is affected, it is an event like a stock market crash or a change in industry regulation. Financial analysts, when determining a project's viability, will alter inputs to variables such as the cost of manufacturing, operating costs, sales volume, to determine which variables the project is most susceptible to. This shines a light on the variables that have the greatest impact to the project, and financial decision makers can direct mitigations to the greatest extent possible. Sensitivity analysis works by changing specific variables. This allows analysts to determine different conditions that will have an effect on outcomes of a specific project. This allows for financial forecasting based on historical data, allowing for more informed financial and investment decisions within a firm. Several steps are required when conducting a sensitivity analysis, broken down into two categories, quantitative and qualitative. Quantitative steps measure the degree of change based on assumed variables and historical data. This includes identification of key variables that will affect the project, for example, cost of goods, cost of operations, sales, etc. Establishing the base case by setting what the most likely scenario is for all of the variables is the first step. This creates a benchmark in which the comparison can be drawn. We vary one variable at a time while keeping the others the same, then recalculate the output or the value of the project via net present value or profitability index, as previously mentioned. Finally, we have graphical representation, which is the assembly of the data in an easy to display and understand graphic so that financial managers and decision makers can see what variables take the biggest toll on a proposed project. Qualitative steps, or the ones that do not necessarily have a numerical data, are assessing the data. This includes reliability of the input data, asking the question, is the data based solely on assumptions or factual historical data? Next, you judge the context of the data. This is an important step. Qualitatively, this looks at external factors like market trends, economic indicators that may be difficult to make numeric, but are important. Interpreting the results through a decision-making lens to discuss the factors that affect the project. You need to look at if the small variables affect the project in a negative way, it may be time to go back to the drawing board on the project. Finally, we need to present the findings to the decision makers and those that have a stake in the project in ways that are easily understandable. The qualitative steps are generally based on interpretation, experience, and judgment, and ensure that the qualitative steps are useful and meaningful. The qualitative and quantitative factors now stand on their own. A good sensitivity analysis requires a mix of data accuracy with experience and informed judgment. Careful consideration of both sets of steps ensures quality decision-making on a project's viability, profitability, and riskiness while establishing what could happen and how to rebound from issues that arise. Sensitivity analysis, when all qualitative and quantitative steps are used, is one tool for decision makers to utilize that determines a viability and risk of a project within the firm. While it is not perfect, as it relies on historical data, which cannot always predict the future, and the results are overly simplified and do not take into account potential relationships between those variables, the sensitivity analysis can be a quick, simple way to determine a project's resilience to problems and frame potential necessary mitigations to ensure profitability.